Good morning, everyone. I'm Brian Chung with Yahoo Finance here at the International Monetary Fund, talking about a number of papers that are previewing next week's annual meeting here in Washington, D.C. And I am sitting here with two members of the research department here at the IMF, Romain Duval and Davida Forcieri. Thank you so much for joining us today.
Thanks, Brian.
So your paper is called Reigniting Growth in Low-Income and Emerging Market Economies. What role can structural reforms play? This paper was just released an hour ago. And by the way, for those that have any questions, you can tweet them at the IMF and us, and we'll ask them here using the hashtag WEO. But your paper, again, addressing emerging market and reform measures that can be done there. What were the key findings of your paper, if you could summarize them?
Well, you know, the background to this is that low-income countries and emerging market economies have had good growth the past decade, right? Even very fast growth in some cases, you know, China, India. But on average, still, they're, you know, closing their income gap with advanced economies at a pretty slow pace. You know, at current growth rate, it would take almost 100 years for the typical low-income countries to just close half of its income gap vis-a-vis the US, you know.
Right.
So you need to do something about it. And at the same time, the macro environment has become a bit more difficult for these countries. You know, there's uncertain growth prospects and policies in advanced countries, waning prospects of a commodity price boom, shrinking fiscal space in those countries also as public debts have increased. So you need to do something else. And that something else could be reforms, right? And what we show in the report is that actually, based on a brand new data set that covers, you know, 70 emerging market and low-income countries since the mid-70s, what we find is that the pace of reforms, you know, these improvements in the functioning of financial, labor, product markets, it has slowed since the early 2000s. Mm-hmm. And at the same time, we find that, well, you know, a renewed reform push could boost growth actually in those countries. It could boost growth by about 1 percentage point a year in the average low-income and emerging market economy, and that would double the speed at which they're closing these income gaps with advanced economies. So basically, well, it's, you know, time for a renewed reform push, basically, provided you do them right, which is also something we look into.
So tell me a little bit more about doing it right. I mean, that's not so much of an easy answer, right? How should governments be creating these reform packages so that they do get it right and that it does have an effect on catching up?
So basically, what we find, what our research suggests, is that timing, packaging and sequencing are key to magnify the effect of the reforms. Let's start with timing. We typically observe that many reforms, like for example reducing barriers to competitions, work well in good and bad times. But other reforms, like making labor market more flexible or providing more access to credit, sometimes they don't work so well when economic conditions are bad. Think about, for example, liberalizing the banking sector, let new banks to enter, but if credit is tight and financial conditions tight, this will not really give a significant push.
Right.
And second, prioritization and sequencing is key. In particular, it's important for policymakers to identify what are the binding constraints to growth. And in the report, we identify two: governance and access to credit. Why this is the case, let me give you an example. Imagine that you do a reform, you reduce barriers to competition, so new firms can enter in the market. But if there are very significant expropriation risks, this firm may decide to not enter. Similar, assume that these firms enter in the market, but still, if these firms they cannot access to credit and borrow for their investment, they cannot physiologically grow. So addressing complementarities of reform, typically by doing governance reform, access to credit, is key to magnify the impact of structural reforms.
Now, another bit, though, that you found also was that the timing of it with respect to the governance systems in those countries is also relevant, right? For a country that has maybe, let's say in the United States, a 4-year term as a president, it's better to get the reform earlier during that term so that you avoid kind of the political hiccups or tie-ups that happen at the end of an administration. Why is that important? And more importantly, how did you measure that? What types of data did you have to use to assess that type of measurement?
So this is actually one piece of research that we feature in this report, but will be fully fledged in another report that will come out next week. One aspect that we look is whether whether government, by implementing reform, they can increase their risk to not be re-elected. So to address this question, we assembled two datasets, a dataset of reform and a dataset of elections for many countries, both advanced and developing, over the last 4 decades. Indeed, as you say, what we find is that the political risk of reform sometimes is overemphasized, and timing is key. Why timing is key? If you implement reforms early in the political mandate, typically government may reap the reward of the medium-term gains of the reforms and typically get re-elected. So the political risk when you implement a reform early is very small. At the same time, if you implement a reform very close to elections, sometimes there could be political risk. And the reason is that some of these reforms sometimes are associated with some short dislocation costs that can affect voters.
And again,
And more broadly, that partly reflects the fact that reforms take time to pay off, right? So the earlier
There's a
you
lag.
do them in your mandate, the more you're going to be able to reap the benefits during your electoral mandate, right? And so before the next elections.
So when we talk about emerging markets, you mentioned that since the 2000s, it's kind of slowed in terms of the effect of these reforms and getting these countries to catch up. As you mentioned, low-income countries almost 100 years behind getting half to the level that advanced economies are at. Why is that? What changed since the beginning of the 2000s that has kind of left emerging markets in the dust?
Well, I think that I would say after the Asian crisis, up to the global financial crisis, there was a good global environment, commodity prices on the upside, and maybe less of a need for reforms, right, to get good growth in emerging market and low-income countries. And that changed with the global financial crisis because growth slowed in advanced economies, commodity prices eventually after a while fell. And so there's now this thinking, I think, amongst many policymakers in those countries that, you need to do something new to reignite growth, right? And that's why there's this renewed interest in doing reforms now that just wasn't there when times were just good, right?
Mm-hmm.
And if I may add also, the reason is part because there was a significant reform push in the 90s, like liberalization of domestic finance in Egypt, in capital account in Romania. And of course, some of these countries now, they did what they could do, but what we identify in the report is that there are significant areas where each country can still do a significant reform push. And just to give you some example, think about Algeria to make the banking sector more competitive, or countries such as Ukraine or Belarus to make the private sectors more competitive and improve governance.
Changes in regulation.
Change in regulation, that there is still significant scope for reform in many countries all around the world. Of course, the specific varies by countries.
So you mentioned, and again, by the way, for those that are watching this feed, if you have any questions, you could feel free to tweet them at us using hashtag WEO. But on the point that you just mentioned, in Algeria, those are examples of reform. We did have one Twitter question that asked, what are some reforms other than forced austerity to, initiate fiscal discipline, right? And this answer might be different for emerging markets than for advanced economies, right? But when we talk about the impact of reform, that it matters on timing, it matters on these other types of things. Are these alternatives to forced austerity that can kind of have that desired effect?
Well, let me first say one thing. I mean, the reforms that we look at in the report are not related to fiscal discipline, are not related to fiscal austerities. These are typically reforms that improve the way government and the market works. But one finding of a previous research suggests that this reform generates significant output gain. What happens when output increases? It means also that the revenue will increase. So other things equal will be that there will be more fiscal space and less debt concern for countries after the implementation of structural reforms.
Right.
So, in other words, what this means is that for some of these countries, actually, they're going to reduce, so some of these reforms are actually going to reduce the need for any austerity, right? Like, for example, if you say reduce barriers to entry in product markets, like licensing requirements, or, you strengthen competition in, say, electricity, gas, telecommunications. If this boosts output, it will boost tax revenue, and so you will need less tax austerity or less cuts in spending, to consolidate your budget. So actually, reforms can actually be exactly the opposite of austerity if you,
right. And again, we're talking about
them well.
reforms that individual governments can do themselves as
Yes.
opposed to kind of wholesale austerity. You mentioned in the paper, and I love the quote that you use here, governments should fix the roof while the sun is shining. Again, talking about the idea of timing of reform being important to the level of potency that it has. It's difficult, though, to see. Governments can't just look outside and go, oh, the sun is shining. Now is the time to implement this reform, right? In a time right now, especially where there's worries about a global slowdown, how should emerging markets assess, is now the right time to be putting in a labor market change here, implementing a regulatory change here to try to make sure that we can catch up with the advanced economies?
Yeah. Well, the answer is going to vary, of course, right, country by country, depending on whether actually they're still enjoying a growth boom or they're facing difficulties right now, right? And we highlight that indeed reforms in general, especially some reforms like labor market reforms or banking sector reforms that Davide mentioned earlier on, these tend to pay off more in good times, right? So if you're in good times, you know, all reforms are going to be paying off. Then prioritization is a bit less of an issue. But it's true that if you are facing a downturn or, you know, like unemployment's growing, weaker economic growth as well, then you need to do three things, I think. One is prioritize the reforms properly, and there's some reforms that you may want to do in these circumstances, like as Davide mentioned earlier on, cutting barriers to entry in product markets, licensing requirements, things we discussed earlier. Second thing you want to do is those reforms that may entail short-term costs, like labor market reforms, you know, say easing dismissal procedures on regular workers while strengthening the social safety net in parallel to protect, you know, workers rather than jobs. Well, you know, what you want to do is pass these kinds of reforms now, but have them come into force later when the economy will have recovered.
Almost like a counter-cyclical trigger there. Yeah.
Exactly. And the third thing you want to do is if you have some macroeconomic policy space, then you can accompany these reforms, right, through stimulus. For example, if you've got fiscal space, public debt is not high, you know, you can actually implement fiscal stimulus to address any short-term costs that these reforms may have. So there's, you know, reform strategies that still work.
And let me complement this on the political economic aspect. Often implementing reform can be tough in bad times.
Right.
What we highlight in this new research is that in these circumstances, especially in these circumstances, what is key is a reform ownership, a credible commitment of governments to pass the reform, to make sure that these are not reversed afterwards, and in particular elicit significant support from the population through dialogue with business and civil society. So these are really key elements to make sure.
So there's also a communication aspect.
Communication
is
really important.
Right. Now, lastly, just quickly, you mentioned some of these concrete actions to improve governance. I mean, every emerging market is going to have their own individual issues, but you mentioned changes on regulation, changes on labor market productivity. I mean, are there specific types of glaring issues within these emerging markets that you think can be addressed through these policies to help them catch up?
Yeah, so, you know, on governance, we highlight that governance can really magnify the gains from other reforms, right? And one example is, you know, if you are going to, say, reduce entry barriers, right, in the product market so that new firms will enter. These new firms will enter much more and will recruit more workers, invest more if they feel they're not going to get expropriated, for example, or they feel there's no tacit government support to the big incumbent firm that's already there, right? And how can you achieve that? Well, you know, through one, strong protection and enforcement also of property rights, contractual rights, right? That's quite important. And for example, some countries have done it, you know, say in 2006, Ghana, for example, passed very interesting anti-corruption laws, including a whistleblower law, you know, that encourage citizens to report corrupt practices to regulatory agencies, the relevant agencies, and that can be quite effective, right?
But let me add also that something that we discussed earlier, that the reform we need in each area is very country specific. And I think the great contribution of our research is this new data set. This new data set allows to really identify the reform gap of each country in each area. And I think this will be extremely important for the IMF and for authorities in terms of policy advice.
Right, and you guys are going to go on the road and share this with other governments, so hopefully they take some of this in heed. And again, as you mentioned, it's not necessarily just economic-related policies. The governance policies also have a big part of this to do as well. But again, thanks so much for joining us, Romain Duval, Davide Friceri for the IMF. Thanks so much for joining me today.
Thank you.
All right.